Turn investing from random picks into a rules-based system you can actually live with. If day 1 gave you purpose and day 2 stopped the leaks, today is about building the engine. Not a hot stock engine. A rules-based portfolio that compounds quietly while you work, sleep, raise kids, change jobs and live your life. We are going to translate your values and goals into a simple construction plan: how widely to spread across asset classes, how to fine-tune inside each class, how much to keep domestic vs global, and how to rebalance without second-guessing yourself. Start with the foundation: spread across asset classes. Think of equity, debt, gold, and real estate as the major pillars of a building. Each holds weight differently, and together they create stability. Your first job is to decide your strategic mix, the calm, long-term proportions you want to live with through cycles. This is not about guessing next year's winner. It's about assigning roles: equity for growth, debt for stability and ballast, gold for crisis hedging and optionality, and real estate for tangible exposure and potential rental income. When you intentionally choose how many pillars and how much weight on each, you reduce regret later because you're no longer reacting to headlines, you are executing a design. Periodic monitoring and rebalancing keep that design intact as markets move, so it remains aligned with your strategy rather than drifting into something riskier without your consent. With the foundation down, we fine-tune inside each asset class, because equity isn't one thing. Inside equity, risk and return live on a spectrum. Large cap shares tend to be steadier and highly liquid, mid caps typically balance growth and stability, small caps and micro caps can deliver outsized gains but will test your stomach and patience. The point of this module is not to turn you into a stock picker, it's to help you decide your style exposure so your returns don't depend on hope. If your temperament is conservative or a big goal is close, tilt more to large caps. If you have time and higher risk capacity, allow more mid and small cap exposure. Your book even lays out sample mixes across these segments for conservative, balanced, and aggressive equity sleeves. Use those as teaching rails while you decide what fits your reality, not your ego. Debt deserves equal respect. Government bonds, high-quality corporate bonds, and different durations serve very different needs. Shorter duration keeps interest rate risk lower and is friendlier to near-term goals. Longer duration can add yield but will swing more when rates move. If equity is your growth engine, debt is your seatbelt, boring, essential, and the reason you arrive in one piece. Calibrate the mix so you can sleep at night and still move forward. My book maps these trade-offs clearly and even shows how a conservative versus aggressive debt sleeve could look in practice. Let that guide how much ballast you install based on your timeline and temperament. Gold and real estate are your shock absorbers. Gold doesn't produce cash flows, but it has a long history of protecting purchasing power when inflation bites or markets panic. Real estate adds tangibility and, if chosen wisely, income and diversification. Both can steady a portfolio when equity throws a tantrum. Use them intentionally, not as trophies. Clear roles, sensible ranges, and awareness of liquidity and maintenance realities. My book outlines those roles, pros and cons, and even example splits to illustrate how these sleeves can be sized. Now zoom out from India for a minute. If all your equity is domestic, your career and your investments may be tied to the same economic wagon. Geographic diversification, via international funds or ETFs, can lower that single country risk and sometimes even benefit from currency trends over multi-year periods. The point isn't to chase Wall Street, it's to reduce concentration. Start small, stay disciplined, and treat global exposure as a complement, not a replacement, to your core India allocation. My book highlights how to think about currency and market-specific risks, common mistakes to avoid, and best practices to implement without drama. With spread and exposure framed, commit to an operating model, fixed or dynamic allocation. A fixed model means you pre-decide bands, say 60% equity, 30% debt, 10% gold, then you rebalance back to target on a schedule. It's simple, boring, and powerful because it forces you to trim what ran hot and add to what lagged, turning volatility into a rebalancing bonus. Dynamic allocation adjusts those bands based on age, life events, or valuation signals, but it requires more judgment and discipline. Choose the one that matches your wiring. If tinkering is your kryptonite, fixed with guardrails is your friend. My book explains both approaches and stresses that the decide first, execute later rule protects you from mood swings. Rebalancing is how you stay honest. Markets drift, your risk drifts with them. There are two clean ways to correct: time-based, for example, check annually or semi-annually, and threshold-based, only act when a sleeve is, say, 5 to 10 percentage points off target. Many professionals use a blended approach: check on a calendar, act only if drift crosses the band. This is risk management, not performance theater, and it systematically nudges you to sell a bit of what's expensive and buy a bit of what's cheap, without pretending you can time the cycle. My book lays out the rationale, the methods, and a practical, set triggers, plan execution, account for costs, document decisions, checklist to keep you consistent. Let's put this together in human terms. Imagine you settle on high-level bands that reflect your life today, perhaps equity for growth you actually need, debt so a bad year doesn't derail school fees, a sliver of gold for shock absorption, and real estate in a measured way if it fits your plan. Inside equity, you tune your style spread, maybe more large cap if you're conservative or a goal is near, more mid, small only if you truly have the stomach and the time. You pick a fixed or dynamic framework that matches your temperament. Then you log rebalancing rules and write them down. When you review, what band triggers action, how you'll execute, new sips first, switches only if needed, and how you'll account for taxes and costs. You are building a personal investment policy on one page that says, here's what future May will be grateful I stuck to. That is how ordinary people get extraordinary compounding, through boredom, rules, and review. 2 final nudges. First, do not let FOMO bully your bands. If a segment runs hot and headlines scream, your rules are what keep your 5-year and 10-year goals intact. Second, track calmly. A quarterly pulse and an annual deep dive are enough for most working professionals. Document your decisions so you learn your own behavior patterns and don't repeat mistakes. My book's emphasis on periodic monitoring and corrective measures isn't compliance, it's the habit that compounds wisdom as surely as your SIPs compound capital. Workbook prompt for this module: write your preliminary target bands across equity, debt, gold and real estate, and add a one-line role for each. Inside equity, note your intended style tilt across large, mid and small caps that matches your risk capacity today. Decide whether you prefer fixed or dynamic allocation and write one sentence on why. Finally, set your rebalancing rule, calendar review frequency, threshold band, and execution method. If you want a starting guardrail to try on paper, my book's examples provide clear teaching templates. Adapt them, don't copy them. Take a breath. You just moved from, what should I buy, to, what am I building? That shift, values into design, design into rules, is how you create a portfolio that funds a stress-free life instead of an anxiety-ridden one. When this session ends, the markets will still move. Your rules will keep you moving toward your life.